In today's chart of the day, Bloomberg News columnist David Wilson takes a look at the gold-oil ratio. He's joining me now with a look at that chart, which comes to us via Michael Shaul of Marketfield Asset Management. So I guess let's start with the basics. Why do people look at this relationship between gold and oil?
Well, if you think about it, they're trying to figure out what's really happening in terms of each market. The idea that if you were really concerned about inflation accelerating or perhaps the opposite, you would see gold and oil move together. Lately, though, you've seen exactly the reverse. You've seen oil tumble, and at the same time, gold has at least been hanging in there. Certainly today, it's higher.
You're definitely not seeing the same kinds of declines in gold that you're seeing in oil prices, so they're not moving in tandem.
Right.
So what do we take away from that?
Well, to Michael Shaul, at least, it suggests that what we're seeing is really a function of what's happening within the oil markets in terms of that drop in price, that it's the basic supply and demand equation has gotten out of whack. There's been an increase in supply the last few years, and even though demand really hasn't gone up accordingly, well, it has happened anyway, and here we are with the price tumbling. So, in other words, that it's more a matter of the supply and demand within oil that explains what's happening, as opposed to some broader economic concern like the possibility of deflation.
Which is interesting because there does at least seem to be some interpretation by investors that that is exactly what's happening, that there is this broader demand and potentially deflation problem, right?
Well, exactly. But the idea in this particular case is that you're seeing the two sort of at odds with each other. And you can go back to earlier instances like this, say 1998, when Russia, an oil producer, got into trouble, defaulted on its debt. You can go back to 1986 when the economy of Texas stumbled. Well, we've seen those peaks happen before, so what we're seeing is, in a sense, a recurrence, and also a bit different in the sense that this time around we're seeing the ratio move higher than it's been in the past. Going back to the 1970s, which is when the chart begins, you see this sort of succession of lower peaks. This time around, that's actually changed, that the peak is even higher, showing that the relationship is even more out of whack than it's been historically.
Does it tend to revert to the mean, and how quickly does that happen?
It does, and it's really a matter of time. Shaul makes a point in a note discussing this chart that if you go back to 1973, it was really the gold market that was driving the peak in the ratio. Ever since then, it's pretty much been oil. So it's a matter of when you see a turnaround in the oil market that may well determine when this ratio starts to come back to something more like historical norms.
And as we know, in recent weeks, it's been a little bit dangerous to try to call the reversal in the oil market.
It sure has, no question about it. And I should point out to your viewers, if you want to see my story and chart and everything I do going forward, I have an email. You can reach me at dwilson@bloomberg.net. That's dwilson@bloomberg.net.
All right. Thank you, Dave. Appreciate it. We're going to leave it there.